Hello, international finance students. We are now in week 2. It is April 8th. And again, as I said, I will post these each Sunday. And it just kind of gives you an overview of the week. So, just a reminder to wrap up your forum discussion today. Make sure you get your quiz completed by Sunday before midnight because that does close out and you won't be able to access it after Sunday at midnight. And again, you get 2 tries with that. So, you should be getting a perfect score on those. And then finally, just make sure your homework is submitted and get that in on time. And what I want to do now is just kind of give you some highlights from this week's readings. Again, with this type of course, the nature of the course we're doing is a concentration. Um, a lot of the reading sometimes can be technical. So if you do have any questions, do send me an email. What I've done is I based the quizzes on kind of low stake quizzes. And as long as you're staying active in this course, you're going to do well in this course. So, but I know especially in chapter 6 this week, it might be a little bit technical reading. So if you come across something you're not sure about, do feel free to send me an emails. But a lot of this, in the way of the nature of concentration course works, a lot of it is going to be on you and to do the reading. That's going to really help enrich your understanding of international finance. Okay, so enough about what's coming up this week and what to do, but looking at chapter 4, I'm looking at my notes here, talk about financial goals, the corporate governance. We run what's called the principal agent problem. As stockholders, we are the principals, if you will, and we hire managers to run the companies. And it's no different for international finance. The interesting thing the authors point out in the textbook is that the difference between public versus private, there's been a lot more movement towards private, especially with a lot of the changes in regulations that required a lot more for reporting, and this increases cost. So a lot more firms have maybe gone private, so they don't have to deal with all those things. But still related to regulations, another reason too is that if I'm not a publicly traded company, I probably am not going to take on as much debt. In the markets, you can issue IPOs and bonds, but I might have to be a little bit more careful too because I'm not going out to the market. In the market, people are willing to take the risk to invest in a particular company, whether it's Amazon or Facebook. But for international finance, we probably see a little bit more trend that it's more private and it's controlled within families. Also, what I wanted to point out in this chapter, it talked, about some of good corporate governance. I kind of like the things they talk about. Experts that both internal and external management compensation aligned with the company's performance. Um, Auditing, that's important too to make sure that people are doing what they say they're doing. And the public responsibility, disclosing things. Another thing I thought about this week, especially with chapter 4, I'll try to remember to post it out there, but it's Hofstede Index. It really tells you about the cultural differences that exist within different countries. And that's something that you really have to adapt to because the accounting practice of the United States, the laws of the United States, those things are totally different when we go into other countries. So I liked how the authors wrapped it up with a triple bottom line, talking about profitability, social responsibility, environmental sustainability. And I think especially those last two, if you've kind of been watching the news this week with Facebook and about people's data being shared, you quickly saw some of the executives come forward and say, hey, this is important to us. We are going to provide more transparency. We are going to make sure that people's data is secured and it's not sold to somewhere else. So they got some work to do because Zuckerberg may have to testify in front of Congress sometime soon because they want to hear about this responsibility. Okay. Chapter 5, you get into a lot more of the foreign exchange market. I would say it's the largest market in the world. You look at supply and demand of currencies. And with that, they mentioned that there's two types, maybe people that get into the market. One is just for liquidity, those that need for transactions. If I'm buying some tractors from Germany and I need to buy euros, that's in the market to provide liquidity. You have the other side that's the speculators that are trying to make a profit from looking at differences in exchange rates or doing different options, futures, forwards, whatever it would be, which we'll learn about more in the course. But they're more speculators, and we need those speculators in the markets to provide liquidity, so they are important. But essentially when a trade happens, you're making some agreement that, hey, we're making a trade this day, and it may settle at some later date. So there's a lot of work done in back offices. And as the text points out today, with the availability of the technology, I used to do this back in the 90s, and it was a lot over the phone calling people. But now, the transaction costs are so low, like almost anyone can get in there and engage in foreign exchange trading at a relatively low transaction cost. And that's because of the benefit of the technologies that we have today. Um, they also talk about the difference between the spot, the forward, and the swap market. The spot is kind of like what the price of the currency is right now. A forward is kind of a promise to deliver a currency at some point in the future. So you're agreeing upon that price to deliver, say, 90 days from now. And swaps, they're a little bit more technical with that, but I like the author's definition. Says simultaneous purchase and sale of a given amount of FX for two different value dates. So that's kind of a simple way to think about it right now. But they talked about a spot against forward, a forward spot, and non-deliverable forwards that are delivered only in US dollars. So, and most of them are done for speculative purposes when you're doing that. The last thing, kind of just wrap up with that chapter, they talked about um, how rates are posted, in terms of the price of the currency. For example, might be euro, EUR / USD might be quoted at like $1.21. And that would mean that for an American to buy €1, it would cost $1.21. And to find that, take a reciprocal. If you put 1 on the numerator and that 1.21 on the bottom, it says for European, it would cost 0.82 of a euro to buy $1 American. So they also talk from a dealer's perspective, like the bid is how much they're willing to buy it for, and the ask, which how much they'll sell it for. Obviously, they're going to buy it lower and sell it higher, so that's how they can also make a profit between those two. And they looked at the last thing was like the cross currency calculations. They gave a comparison of like the yen and the peso. So, kind of based within dollars, what would one currency trade for the other? So it kind of puts things in perspectives. And because the U.S., just how they dominated out of the Bretton Woods system, a lot of things are still based on kind of dollar comparisons. That may change someday in the future, but I don't see that changing anytime soon. All right, last thing with chapter 6, talk about international parity conditions. This chapter does have a lot of technical reading, so just go slow. You kind of, I especially like the examples that they walk you through in the little boxes. So, there's one in particular, that you like, how did they get this number? Well, I remember what they did is they kind of took that 1 over that currency rate and multiplied by this dollar amount to show like how much the profit was made for the dealer, or the broker, I should say. So, but with this, they talk about the idea in theory a lot. They use an example of a Big Mac index, and the idea with like foreign exchange, that if I buy a Big Mac in the United States for $5, if I took that same $5, I converted it to some other currency like a euro, I should be able to go to Paris and buy that same Big Mac. But there are problems that exist. First, that Big Macs are not transferable. We can't ship Big Macs overseas. But there are other products, goods, and services that in theory, if you think if something is very expensive in the United States and I can go up to Canada where it's much cheaper, eventually smart entrepreneurs will bring that product out of Canada and in the United States. And then all of a sudden in Canada, there's less supply available, so the price should go up there. And as more comes to the United States, the price should go down. So it's an idea of like the law of one price. But we do find that there are certain currencies that are undervalued or overvalued, that I could go down to Mexico and enjoy something at a much lower rate. But it says in theory that eventually we should move back to that same relative price over time. It may not happen very quickly. And also they go in this chapter as they talk about the idea of like the Fisher effect and real interest rates. Real interest rate says, hey, if there is some nominal rate out there, we know that there's some rate of inflation in that country too. So investors will make decisions based on real rates of return, and money will flow that way based on those real rate of returns or expectations about what's going to happen to the price of the currency. So even though there might be differences in the exchange rates, what it says in theory, especially when they got you readings on what they call like these forwards, you're going to be able to determine these forward rates in theory based on these interest rate differences. And you're saying, hey, do I want to take something in the United States at 6% or something in Japan as 4%? Well, I'm only willing to take that if I know and I believe that the currency is going to appreciate in value, then I'm going to make up that return. So like from a US perspective, if I invest in the yen and it appreciates, when I convert it back to dollars, I'm going to get a higher rate of return. So again, this is a lot of theory, and that's what you're going to read a lot about in Chapter 6. So, all right, well, that's it for this week. But if you do have any questions, do shoot me an email, and I look forward to talking to you online. Take care.